So I have one of the past ACCA questions here for us to check out. So the requirement of the question is what we are going to check first. So let's have a look at the requirement of the question. So the requirement of the question says here, so it says, what will be the depreciation charge in Vinton's statement of profit or loss for the year ended 31st March 2015? Okay, so that is something we need to get right. Let's return to the question. So we have the question here. So it says the following trial balance, as a matter of fact, the extract. So the following trial balance extract relates to a property which is owned by Vinton as at 1st April 2014. So we have on the debit side, property at cost, 20-year original life, $12 million. And then on the credit side, we have there, it says accumulated depreciation as at 1st April 2014. This is $3.6 million. All right, so I have a timeline that I'm going to show you, but I just need us to be mindful of the year end. So we have the year end here saying 31st March 2015. So let's come to the timeline that I have here. So the year end is this, 31st March 2015, and the period will have started on 1st April 2014. So if the year end is 31st March 2015, this period must have started on 1st April 2014. So I have the starts of the year to be this, and then the end of the year to be this. So please, let's take note of that. Good. The other thing I'm going to do now is to bring this bit to where I'm going to be showing you how to go about it. So please, can we just look at this bit? It says property at cost, 20-year original life. So that same information is what I have here for you. So I have it here. Okay, so what is the 20-year original life? What was they saying? Well, what it's saying is this: as at the time we bought or acquired this property, we acquired it for $12 million, and the estimated useful life of this property as at the time of acquiring the assets, look at it here, 20 years. How did we get the 20 years? Oh, it's given to us in the question. So look at the bracket here. So I have it there for you, 20 years. All right, so going back to the question, I also want to bring this in, this other bit that is talking about the accumulated depreciation. So let's come here. That's the same thing that I have here for you. So let's talk about that. So it says accumulated depreciation as at 1st April 2014, 3.6. Remember, we have dollar and 3 zeros there. So the 3.6 there is actually $3.6 million. So the explanation of this: when we bought the assets, we acquired it for $12 million, and accumulated depreciation of 3.6 is saying as at 1st April 2014, the company had enjoyed a total of 3.6 out of the 12 million. And if you deduct this 3.6 from 12 million, you will have this left, which is $8.4 million. The $8.4 million will be as at day one of the current year, which we have it to be 1st April 2014. Okay, now the other bit I need to explain to you is this: if when we bought the asset, the value was $12 million, and the estimated useful life was 20 years. So the question now is this: what will be the per annum depreciation charge? The per annum depreciation charge is what we are going to determine here. So you say the $12 million divide it by the estimated useful life of 20 years. And tell you what, that will give us $600,000. So there you have it. Okay. Now, for every year, the enjoyment from this $12 million is going to be $600,000. And if I take you back here, this 3.6 is saying out of the $12 million, the total amount of enjoyment as at 1st April 2014, look at it here, you have it to be 3.6. So the question we're going to be asking now is this: how many years of enjoyment do we have in the 3.6? Because, like, if per annum depreciation charge is going to be $600,000 and we have 3.6 as the total enjoyment as at 1st April 2014, so that tells you now that we have more than 1 year in this 3.6. So how do we determine the number of years of enjoyment in this 3.6? We'll come in and determine it. So we'll say the $3.6 million, how many 600,000 can we find in there? So it's going to be you picking the 3.6 and you divide by the per annum depreciation charge of $600,000, and tell you what, that will give us 6 years. So the 6 years, please look at it there. So you have it there. So that means in that $3.6 million, there are 6 years of enjoyment in there. Okay, so it makes sense to make this conclusion now and say, if as at the time of buying the assets, the useful economic life of the assets was assessed to be 20 years, and as at 1st April 2014, we already enjoyed 6 years out of the 20 years. Tell you what, it means as at 1st April 2014, the useful economic life of this asset will be 14 years. So as at 1st April 2014, the remaining balance of this asset, the property, will be this 8.4. So it will be $8.4 million. And the remaining useful life of this asset on the same date, 1st April 2014, will be 14 years. So what we have in terms of the dollar will be 8.4. In terms of useful economic life, it will be 14 years. So I'm going to pick this 8.4 and 14 years and put them somewhere here. Now, since this is the start of the year, so we have the start of the year here, so I just want to drop the $8.4 million here, and the useful economic life of 14 years will come up there. Okay, good. The other bit now is to go back to the question and read what we have there. So we have this other bit that says, let me tidy up this. So we have this other bit that says, on 1st October 2014, following the sustained increase in property prices, Vinton revalued its property to $10.8 million. So there are two things I need you to be conscious of here. So you have the date of revaluation exercise to be 1st of October 2014, and then the revalued amount is given to us in the question to be $10.8 million. So let's return to our timeline and put this there. So on the timeline, I have the date. That's talking about the revaluation date, 1st of October 2014, and we've been told that the property was revalued to $10.8 million. Please have a look at the $10.8 million here. Good. So what are we going to do now? Well, I don't know if you are looking at it already. It means if we started the current year here, and this happens to be the date of the revaluation, would you agree that the company first enjoyed this asset for the first 6 months before this revaluation exercise took place? And how did we arrive at the 6 months? Oh, very simple. So we have to count. So we are going to count our fingers now. So from the beginning of the year, which is 1st April 2014 here, let's count to the date of revaluation exercise. So we're counting now from the month of April. So April, May, June, July, August, September. So I'm thinking that we're not going to count the month of October because what you have there is saying 1st October 2014. So as at the date of revaluation exercise, if you want to lay claim to the month of October, you will just have in there 1 day, and this 1 day will not be material regarding this calculation. So we have the number of months to be 6 months. 6 months from the date the current year started down to the date of revaluation exercise. So the company first enjoyed this asset for the first 6 months of the year before the revaluation exercise took place. So what are we going to do now? Let's account for this 6 months depreciation. How do we account for it? Very simple. Now we'll pick the 84 here, and that's what I have here, and divide by the 14 years, and that's what I have here. So if you do just that, 84 divided by 14, what you have will be $600,000, and $600,000 will be for 12 months, a whole year. But remember, we are looking at the first 6 months. So what you are going to do is to divide your answer by 2 to scale it down to 6 months. So 84 divided by 14, that will give us 600,000, and then you go ahead to divide your results by 2. So 8.4 divided by 14 divided by 2, that will give us $300,000. So what's that $300,000 telling us? So it means the company put this asset into 6 months before they revalue the assets, and the 300,000 is going to be the enjoyment for the first 6 months. Or put it in another way, the 6 months enjoyment will be $300,000. Okay, that is fine. So the other thing I want to show you now is to explain the concepts that says if you revalue your assets from that date, which is from the date of revaluation exercise, you do not have the carrying value of the asset again. Instead, what you have will be the revalued amount, the market value. So first thing first, can we determine the carrying value of this property as at the date of revaluation exercise? Carrying value is also known as carrying amount, or you want to say net book value. So if you remember, we started with $8.4 million, and out of the $8.4 million, we enjoyed $300,000 for the first 6 months. So if you want to know what we have left as at the date of revaluation exercise, it will be 8.4 minus $300,000, and tell you what is going to be this 84 minus 300, and that will produce 8.1. So if we will not revalue as at 1st October 2014, what this company will be having left will be $8.1 million. However, the company decided to revalue its property. So the current value is 8.1 as at the date of revaluation exercise, but the market value, look at it here, is 10 point or was 10.8, as the case may be. Okay, so now the current value will say one thing, the market value revalued amount was saying another thing, a different thing entirely. So anytime you revalue and the revalued amount, otherwise known as the market value, is higher than the current value, there's going to be a difference. That difference is going to be a gain, and the gain is referred to as revaluation surplus. So we have a revaluation surplus of 2.7 here. How did we arrive at that? Well, the current value is 8.1, market value is 10.8. So if you find the difference, you have 2.7. So that could be your question. The examiner could ask you to determine the revaluation surplus as at the date of revaluation exercise, and the answer to that would be $2.7 million. But that's not the requirement of the question. So the requirement is asking us to determine the depreciation charge for the 12-month period. And we have 6 months to that effect. So the first 6 months, we already have, for the first 6 months, we already have the depreciation charge to be $300,000. So you have it $300,000. So what we need now is the depreciation charge for the second 6 months. How do we go about it? Very simple. So you remember the principle that says that once you revalue your assets, you do not have the current value of the asset again. Instead, what you have now is going to be the market value. So as at the date of revaluation exercise, this is the date. Even though the current value was 8.1, but it will be 10.8 that you will pick for the value of the asset. And look at it, the 10.8 is here as at the date of revaluation. So if I can do this, so this is the date of revaluation. So that arrow tells us now that as at 1st October 2014, the market value was 10.8. Okay, so before we go any further, let's ask this question. We know the current value as at the date of revaluation exercise to be 8.1. Okay, how many years would you say we'll have in this? Well, think about it this way. If at the start of the year we had 8.4, and in this 8.4 was 14 years, but then remember we first had 6 months enjoyment. So the way this works is this: out of 14 years that we started the period with, the first 6 months will reduce the 14 years to 13.5 years as at the date of revaluation exercise. So what we are saying now is this: if we can push this to the date of revaluation exercise, which will be 6 months, so the 6 months away from the 14 years here will leave us with 13.5. So 13.5 is what we'll be having left in here. So this is 13.5 years as at the date of revaluation exercise. So are we not going to enjoy out of the 10.8? Oh, of course we are going to enjoy out of the 10.8 for the remaining 6 months. So what do? Let's determine the amount of depreciation for the second 6 months. So for the second 6 months, you pick the 10.8, you pick it and divide by the 13.5 years, the remaining useful life as at the date of revaluation exercise. And if you do that, what you have will be $800,000. That $800,000 is going to be for 12 months. It's going to be for a whole year. But remember, we do not need a whole year any longer. We just need the remaining 6 months. And this is why you have to divide your answer by 2. So it's going to be 10.8 divided by 13.5 years. And that will produce 800,000. So divide this into 800,000 by 2, and that will give us $400,000. So the first 6 months, the depreciation is $300,000. Second 6 months, the depreciation is $400,000. And the question is asking for depreciation charge for the 12 months. So the 12 months is from the beginning of the current year. Now look at the beginning of the current year here. So the first 6 months is depreciation charge of $300,000, and then the second one is $400,000. So $300,000 plus $400,000. Now look at it. That's what I have here. So $300,000 plus $400,000, and that will give us $700,000. Okay, where will this go to? Well, it will go to the statement of profit or loss, and the cost of sales will be the one to accommodate it in the statement of profit or loss, unless otherwise stated. Okay, good. So, what's this saying? Well, we've come to the answer that the examiner will be expecting us to drop for this question. So, the 12 months depreciation charge will be $700,000. But if you look at it, I also put debits. So the debit is talking about the nature of this depreciation. So depreciation is an expense, and for every expense you have in the expense account, is going to be a debit entry. So this $700,000 is an expense. Depreciation is an expense. It's going to be part of the expenses of the year, and for every expense you have a debit entry in the expense account. Then, just in case you want to know the implication of that on our profit, so what an expense would do would be to reduce our profit for that year. So the profit of the year will be reduced by $700,000. Okay, so the original question is asking us for the depreciation for the year. So if we go back to the options, you pick option C that says $700,000. So that's going to be the answer. But I just want us to do more than this, because you step into the exam room now. The examiner might not ask you for the current year depreciation charge. Instead, the examiner could ask you to determine the amount of revaluation surplus upon revaluation. So you remember we spoke about it at that time. Revaluation surplus is going to be the difference between the market value, revalued amount, and the current value as at the date of revaluation exercise. So that difference is what's produced these 2.7. So 2.7 could be your requirement instead of the $700,000, which was for the current year depreciation charge. Okay, where will this 2.7 go to? Well, it has a couple of places to go to. It will go to statement of changes in equity, and that same figure will also find its way in statement of financial position under equity. And just in case the examiner is asking you to prepare statement of profit or loss and other comprehensive income, so immediately you determine the profit for the year. There are a number of items that will come immediately after profit for the year, and one of them is the revaluation surplus of the current year. So this same 2.7 could appear under OCI. OCI is other comprehensive income. Okay, so the 2.7 will go to statement of changes in equity. It will also find its way to statement of financial position under equity, and in case you are asked to prepare statements of profit or loss and other comprehensive income. Now, this same 2.7 will appear as one of the items of OCI, other comprehensive income. So you must have noticed that we have credit attached to it. So revaluation surplus is going to carry a credit entry in our equity statement of changes in equity. It will go in there as a credit item. All right, that's that. Now, there's this other thing the examiner could ask for. Still talking about the same question. So the examiner could ask you that at the end of the year, what will be the current value of this assets? At the end of the year, the current value. Well, the current value of this, if we can go back to the timeline. So we started the year here, and then we had 6 months, the first 6 month depreciation charge of 300,000. And on the date of revaluation exercise, here, 1st October 2014, the revalued amount as given to us in the question was 10.8. So you do not have the current value of 8.1 anymore. What you'll be having as at the date of revaluation exercise would be the market value of 10.8. But then you remember that out of the 10.8, we enjoyed for the second 6 months $400,000. So it will be a thing of 10.8 minus this $10.8 million dollars minus this $400,000, and that is what I have here for you. So it will be $10.8 million dollars minus $400,000, and that will give us $10.4 million dollars. So what is this saying? From the timeline, 10.8, remove this, and you have this. So as at the end of the year, what Vincent will be having left as the value of the asset will be $10.4 million. And that's what you have here, $10.4 million. Now, you must have noticed I put DR there, which is debit. So when you have an asset, in the asset account, that asset will attract or will have a debit entry. So it's going to be $10.4 million debit. And where will this go to? Well, it will go to the statement of financial position. Statement of financial position under non-current assets. Is going to be part of property, plant, and equipment. Okay, good. So 10.4, there you have it. So these are the 3 things the examiner could ask for regarding this question. So current year depreciation charge, you have it to be this. Revaluation surplus, you have it to be this. And then you also have the current value of the assets as at end of the year. Okay, so whoever is going to get this right must have some knowledge of how to account for depreciation, the knowledge of pathway through revaluation exercise. So all of this, the examiner featured in this particular question. And it shouldn't be a problem for you if you understand the concepts of this. So I just thought of it. So for candidates preparing for financial reporting exam, please, this video will be a good one for you to check out. All right, so we've come to the end of this. Video, and I just want to thank you for staying this long on this video. So in case you want to reach out to me, the name is Ayorinde Temitope. Reach out to me using the WhatsApp number. So the number is +234 803 385 1555. All right, so once again, I want to thank you for your time. Please, if you have found this video helpful, please subscribe to the channel, and it will also be a good thing if you could do well to share this video so that it could reach other people who will probably not be checking it out at this point. All right, so I'll see you in my next video. Bye.